All right. Why is the US government practically guaranteeing us a risk-free trade in gold? Well, let's go to this post I did on Gold Tent and how I'm figuring out that gold owners are actually the ones that decide the health of the fiat currency. And when they decide that they don't have any more faith in the fiat currency, that's when they remove their bid for paper money. And that's when it's just game over. They remove the bid, and then after that, gold goes in permanent backwardation. You could have trillions of dollars of fiat paper. You won't even be able to buy an ounce of gold. So let me just read this. Gold has started doing backwardation, some spot in the late 90s. Here we have a cluster of backwardation spiking here at close to 2011 when the price was really starting to go up before it crashed down. That's a lack of trust, a huge lack of trust by the gold owners in fiat currencies. And here we have a more cluster. They're not trusting. And right here, we're having another spike of this lack of trust seen through backwardation. I invite you to go check out goldstandardinstitute.net when gold backwardation becomes permanent. Some really enlightening stuff. I had to read that multiple times to try to understand. So at first, I was trying to figure out why in the 1980s I didn't see any backwardation. Well, it's all this podcast there from quote the Raven interviewing George Gammon, and there was they were talking about debt to GDP ratio, and they were explaining that Volcker was able to go super high in rates in the 80s to fight inflation because they had a very manageable debt to GDP ratio, 30% of the US debt, and permitted to do so. So now for me, I see that as, if I'd be a gold owner back then, I say, okay, that's honest. There's inflation. They're trying to keep the monetary imbalances healthy. So gold owners probably accepted that. It built trust in the fiat currencies. They did not remove their bid for the paper fiat, hence no backwardation. So for me, that's why in the 80s we had absolutely no backwardation in gold. They saw monetary policy was healthy. They did what they had to do to preserve the value of the fiat currency. But now, fast forward to 2009, more debt, less GDP, where the ratio now is above 60% debt to GDP, trust diminishing, hence more events of backwardation. And we saw it in the cluster here I showed you in the 90s, and especially more since 2009 to today. Even recently, we had a big spike in the backwardation. So for me, that's starting to align with the backwardation theory that eventually it's going to be permanent backwardation. Even $1 trillion of fiat currency won't even be able to buy you an ounce of gold. And that could probably happen. We're not going to go there yet. We're probably going to go exponential. So exponential amount of fiat currencies to buy that ounce of gold until eventually that total trust total distrust is obtained, and the gold owners we stop bidding for fiat currencies. And look at that. When you match gold, so this is gold, analog chart. This is debt to GDP. Do I have analog chart? I think, yeah, it's still analog chart. And look at that, how it matches. Oh, starting to go down. The GDP, gold. Okay, the GDP is getting healthier. So I see debt. Remember, money as debt or currency as debt, if you want to be more precise. That's what money is. That's what currency is, right? It's debt. And what value does it store? Well, it stores production, GDP. So the more debt you have, the more you dilute that same GDP. And if GDP actually decreases, then that's the other part of the equation. So that ratio shoots up. So right here, look at that bottom. Smack down there. So when debt to GDP started rising up, that means you're diluting the fiat currency. Then gold, same thing, right? Gold is priced in that same fiat currency, and it goes in that same trend until here. Oh, it's starting to slow down. Maybe there's hope for that debt to GDP to try and normalize it. Either GDP is going up or that debt's being reduced. Gold says, okay, time to slow down. I have to try to follow that money or that environment. is healthier. It's not just the value of the US dollar. It's just we trust more that fiat currency, the backing, the value of it through GDP is healthier. So we're going to slow down. And look at that, the bottom practically the same. And no, spiked up. False going down, debt to GDP, there's more and more debt, deficits are getting bigger, or the GDP is less and less. And look at that, it's creeping up. And I think this one is from October of 2019. So imagine the next quarters is going to probably be shooting up, and that's probably gold what's stiffing out, that it actually knows that that the GDP is already starting to rocket upwards, guys. I decided to have a little fun also. Japan, same thing. Their debt to GDP, we know that it's 230%. So here's the debt to GDP, linear, since it's already a percentage. I decided to keep it linear this time. Here's gold expressed in yen, and look how it follows. Debt to GDP keeps going higher and higher, so more debt for that same GDP. And gold keeps going up, tracks it very, very, very well. So gold at these levels right here, and here I did a mistake. Gold, yen did not explode when it was 100%. It was actually more 168%, and then gold expressed in yen, not revert to mean, but close the gap to track it, same direction. So this USA is about here right now. So this could be in USA's future. If they go to a 200% or 300% GDP value, then you could see that eventually, yes, it could be sideways move, but gold will track that that environment of that unhealthy environment where you have too much debt, which is diluting the actual production, the value that is trying to store. All right. So here we go to the final part. I've checked other. I found this other GDP or this debt. So there's this net debt percentage of GDP. Same thing again. It tracks very well. Here you can see the description. Net GDP is estimates. They started doing that in 2017. It's a gross debt minus financial assets corresponding to debt instruments. Monetary gold, SDRs, currency, deposit, debt securities, loan, insurance, pensions, standardized guaranteed schemes, and other stuff. But you see pretty much the same thing. Gold tracks it. So whenever that percentage of debt dilutes, gets smaller and smaller, that means there's less debt for that same GDP. Gold says, okay, we trust more that those monetary balances, and when it starts getting imbalanced, and look at that, just follows it sideways. And what's kind of cool for this net debt percentage of GDP is they actually started doing estimates since 2017. And this is an actual estimate I got. And they have it at 94%. They're already estimating either GDP going down or net debt going up or a combination of both. So already, if you track that, 94%, draw a line for 2024, for the end of 2024, you already see it's going up. Gold's already starting to price that in, and it could actually go a lot higher if they underestimated the net debt or they overestimated the GDP growth. What else did I add? The rate of change. So here's the rate of change for that net debt. And rate of change is often more telling because often nominal values that just keep building up and down, you kind of see, okay, its relation to gold is good, but sometimes it's just the actual fluctuations happening. So here's a yearly rate of change for that net debt percentage of GDP. And you see here, it's just going down. Gold, how it's reacting, same trend, going up, higher lows, gold reacting to that rate of change. And here, same thing again, rate of change going down, and now starting to go back up. Gold, same bull, same arc pattern, reacting really, really close. So we're getting to see that gold really reacts well to the store value, and that's its goal. That's the role of gold, right? Is to store value. So if its currency is in the U.S. and the store value is debt, money as debt, currency as debt, and it's storing actual GDP, So it's fluctuations. It's just natural that gold reacting to that. Look at that. This is for the federal debt, the total public debt. So not the net debt, the one that pretty much everybody looks at as a percentage of gross domestic product. Look at that. Same angle. Same going down, trending down. Oh, trending up, going up, down, bull. Pretty much the same pattern. So for me, gold is a store of value. And the same store of value, you could see it through the debt. Money is debt. And what it's storing is the gross domestic product. So where does that bring us? How I see this as a guaranteed trade, long gold trade by the U.S. government is this, the debt to GDP. We know growth is going down, it's been trending down. Weight of evidence, we saw copper's trending downwards, world GDP is stagnant. There's a whole bunch of charts and metrics giving high probabilities that world growth or the US growth is either going to stagnate or go lower. Even with the COVID virus, we're going to actually have a lower rates of growth of GDP incoming. We're heading to recession, etc. All that. So here, the GDP, the denominator is going to be going smaller and the debt's going to be higher. So that percentage is going to keep skyrocketing. We're at 106%. This should skyrocket. I wouldn't be surprised that we hit 200% with the U.S. deficits, with trillions being printed, stimulus packages. That ratio is just going to shoot up. And that's what gold is actually sniffing out. This is really going to go higher and higher and higher. So if that correlation keeps going up, for me, gold it's a no-brainer. It's going up. What I was trying to think is why. I always try to think of both sides and why could this fail? Sovereign default. I don't know if now the U.S. having 100% or going to 200% of its debt to GDP, it's going into Japan territory, it's going into Venezuela territory, it's going into all these countries that either had defaults or hyperinflation. But without going into that, trying to extrapolate, okay, USA has reserve currency, it can never default. Or if USA doesn't default on its debt, then gold should keep going up. If it defaults on its debt, that's currency that's going to disappear. If the debt goes down, then that ratio should go down. So if gross domestic product remains the same and debt goes down, then that ratio should start going down and gold should start going down at the same pace. So as long as you're convinced, a weight of evidence that debt has to keep going up or is going up or it's planned to go up, and we're seeing that all over the news, and we have to try to figure out if it's going to keep doing it, then for me, gold is a guaranteed trade by the U.S. government just by its policies that it's doing right now. As long as it doesn't default, go in sovereign default, I believe that gold is on track to follow this insanity of money printing, of stimulus and all that with barely no growth. Gold's going to keep going up and up and up to preserve value and expose the value loss in that fiat currency. All right, guys, don't forget to subscribe if you like this, and I'll try to do a podcast as soon as I have these light bulb ideas that pop in my head. Ciao.